So congratulations for making it to the end of the course. In this section, we will attempt to put our learning into actionable steps. So let's start with the first topic. That's investing versus trading. So here let's try to understand what is the key difference between the two, and where do you stand on the scale between an investor and a trader. So trading and investing both involve seeking profit in the stock market, but they pursue the goal in different ways. Stock trading is about buying and selling stocks for short-term profit. Investing is about buying high-quality stocks for long-term gains. So if I look at the key differences, investing can be of two types: value investing and growth investing. Trading can be differentiated between positional, swing, and day trading. So that how this is different, this is different is based on the time frame that we are looking to invest, or the time frame that we are actually looking to put our money in for. Okay, so as a value investor, you don't want, so you are looking to buy till perpetuity, and you don't really have a selling point in place. You'll probably keep it till your retirement. So if the value investor is here, the growth investor is someone who wants to participate till the point the company is showing growth and the stock price is also showing outperforming the benchmark index. So that could be anywhere from 1 year to maybe 3 to 5 years, depending on the cycle that we are in. So the growth trader can be somewhere here. So this is basically time of of holding hold. So this is the value investor, this is the growth investor. Then we have a positional trader who holds a position in stocks. Could be anything, could be a growth company or a mature company or a decline company, but he or she is looking to hold the position for about a few months to about a year, maybe 1.5 years. So I will put the growth investor over here, positional trader over here. Then we have a swing trader who would buy and who would build positions and he might sit into it from a few days to a few weeks, or maybe 2 3 months. So this is where I will put a swing trader. And then you have the day trading, or a day or short term trader. So this does not actually mean, like, does not always mean that someone who buys in the day and sells at the end of the day. It can also mean that someone who buys today and holds the position for a few days. So maybe he buys on Monday and sells on Friday, maybe he buys on Monday and sells on Wednesday. So those things are also possible. So the shortest is the over here is the day trader. So you need to understand where you are in this spectrum, and most of our discussion in this course to has been around the investing part. And once you learn once you are on your way to becoming a good investor, these things come much easier. So anyways, getting back, holding periods are longer, as you see over here. These have much shorter holding periods. Focus is on wealth creation. Focus is on income generation and reinvestment. So by wealth creation, basically you are adding stocks in your portfolio to increase your overall net worth, and you will hold them as multiple market cycles play out over multiple years. Whereas in trading, it's for income generation, where you want to make an income to meet your living expenses, or you want to make an additional income that you will again reinvest in the market, and move that money into investing for wealth creation. Passive management. So this does not require daily management of your positions. You don't have to look at charts, changes in price on a day-to-day basis, but you can set levels and track it on a at a much slower pace. Trading actually involves much more active management. To it could either mean that you are short screening stocks every week, then you are waiting for your entry and exit points to come. So this requires much more time commitment from your end. So, unlike popular belief, to succeed in either of them, you require knowledge of both fundamentals and technicals, as we had discussed. So, most of our discussion has been, as I said, around investing, but we did cover both aspects, as I very strongly feel that both are equally important. Now, as an investor, how should you set up your portfolio? So ideally, if you have some other source of income or a salary or a business that you run and you get income from there, you should put some amount of your income, or some amount of your savings, a percentage of your savings into the markets, uh, because over a long term you will be able to get better returns when compared to bank deposits and other fixed income instruments. So, how you should break your overall portfolio should be 70 to 80% of your portfolio should be core, and then you have 20 to 30% which is called satellite. So core portfolio tends to track the overall market, whereas satellite portfolio's job would be to deliver that alpha, which is the additional return that over the available market return, which you can generate by participating in growth investing and buying value stocks when the time is when the opportunity presents. So it's always wise to keep some amount of your portfolio as cash and invest it when exceptional or asymmetric opportunities present themselves. So your core portfolio should be regular long-term investments, high quality stocks. Please ensure that it is only in high quality stocks and bonds. For this, you can pick the large cap mutual funds from some of the best fund houses in India, multi-cap funds, ETFs, basically Nifty ETFs, which track the movement of the benchmark index. Nowadays you have ETFs of sectors also. So any sector that you think is will do well in the long run. Banking, for example, banking in India. So you have bank ETFs, you have finance ETFs, you have IT ETFs. Then government bonds. So these are already part of some multi-cap or hybrid funds. So ensure that your core portfolio is invested in the highest quality of investment instruments available in the market. So as we discussed, market always moves up in the long term in a growing economy, and India is a growing economy. Then comes the satellite part. So this can be value and growth stocks identified using fundamental and technical analysis. So in case you want to participate in the market in a more active way, you can, as I said, put aside 20 to 30% of your portfolio that you can manage on your own. And for this, the steps that we have discussed is a good starting point for you. And you can look out for growth stocks and value stocks in the right market cycle. So when the market cycle is actually coming out of stage one, this is where a lot of growth stocks start their journey upwards, and it's a great buying opportunity. And when the market is also coming out of S1, some of value stocks are also available at a discount. Or when a sharp correction happens at this point, again value stocks become available at a discount. So if you are tracking the markets and have identified beforehand growth stocks and value stocks based on both fundamental and technical principles, you can do very well in managing a satellite portfolio and generating an alpha from the market. By alpha, I basically mean that if the core portfolio, which is tracking the market, so if the market is giving on an average, say 10% per annum return, your satellite portfolio can give you that additional, say, 7 to 8% in a good market, and take your overall annual return from 10% to actually 15 to 18%. So that's the advantage. So example here, correct entry mechanism and active risk management is required for a satellite portfolio. COVID correction and post-COVID rally was a good time to buy such stocks and funds. So there are a lot of funds also, growth funds or sector-specific funds. So suppose you believe that the IT sector will do well, you can just start putting money in a IT focused mutual fund, and you can follow the same stage analysis to enter and exit in the fund. So let's discuss the two investing approaches, growth and value. So there are two different approaches of investing in the stock markets. Growth investors seek companies that offer strong earnings growth, while value investors seek stocks that may be undervalued because of certain market conditions. So when there is an event such as a war or the COVID crash, suddenly great companies or mature companies which are highly profitable become available at a discount. So this is the time where a lot of value investors start hunting for bargains and value deals. Whereas growth investors are always seeking companies that are growing, that are able to deliver sales and earnings growth. And in the right market conditions, these growth investments can give staggering returns for the investor. So growth stocks. Strong earnings and profit growth tend to outperform the broader market. They are more volatile, thus the risk is higher. They need active management. If growth does not come, prices correct rapidly. So that is why it is very important. So that's why it requires active management of both the price chart as well as ensuring that quarter on quarter fundamentals are at par with the expectations. Value stocks. They have consistent earnings and profit, typically mature companies. They are or they become value when they are trading below perceived price. They are less volatile and tend to follow the broader market during normal times. They need passive management because generally the companies are just following the market, but only when you see an opportunity arise do you need to look out for the best deals. In weaker market conditions, good companies are available at good value. So, okay, this we discussed earlier as well. Now, at this point, you need to identify how you want to participate. Do you want to be a growth investor? Do you want to be a value investor, or combination of both? So as we discussed earlier, so your core portfolio that is already being allocated in the form of SIPs or lump sum or however you want into funds that are some of the best funds available in the market, and the other the satellite portfolio that you want to manage on your own, which is basically you keeping cash aside for to invest in opportunities as and when they present. That part is what we are discussing here. So within that, how do you want to participate as a growth investor? That means in the right market cycles, you are constantly evaluating companies for investing opportunities, or as a value investor where you actually wait for market cycle, you are tracking the market cycle and wait for dips in the market or discounts in the market to bring in that money. Or you want to be a combination of both, where in good markets you are a growth investor, and when the markets are down you are a value hunter. So my suggestion would be to stay in, participate as a combination of both. So now the next steps for you would be, first is to identify how you want to participate. So we discussed this either as a growth investor, value investor, or a combination of both depending on the market cycle. This is where I would want you to be. Then the next thing that is extremely important is to understand your risk. So investing without risk management is just like gambling. So at any point, you should be aware of how much money you have invested, how much open risk in terms of how much are you, in case your position does not work out, where is your stop loss, how much will you lose, how much will you lose, and these things have to always be in your control. So do not risk more than 2% of capital on any trade. In case markets are weak, limit it to only 1%. So 2% of capital does not mean the entire capital. It means the capital that you are using for your satellite portfolio. So suppose you have 50 lakhs invested into the market, or this is your total portfolio size, about 70 to 80%, say over here, let's say 35 lakh goes into your core portfolio, and the 15 lakh you are managing on your own in your satellite portfolio. So in a good market cycle, if you're risking 2% of capital on any trade, obviously you will not be buying like you won't be buying only one position for 15 lakhs. So suppose you have bought four stocks as part of that cycle, and in each of them you have about say 3 to 4 lakhs invested. So the risk per trade would be 2%, so that is about 30,000. 2% of 15 lakhs, so that will be about 30,000 rupees across each of the four trades. So this 30,000 into 1, 2, into 1, 2, 3, 4. So that will be total risk of about 1.2 lakhs, which is less than 10% of your total portfolio in the satellite total satellite portfolio. So that's how you have to manage, and as your stock moves in your direction, you have to keep trailing your stop loss so that you are reducing your open risk per trade. So this 30 will reduce to 15 to 10 to 5 as your stock moves in the favorable direction. So mark out your stop loss, and mark out your stop loss below the stage structure after you take an entry, and as the bases are formed, keep trailing it as the stock continues to move up. In case of an SIP type of an investment, you can pause or exit if the stock moves into stage 3 or stage 4. So whenever you are unsure of an investment, that is the best part about doing an SIP. Whenever you feel uncomfortable or the market cycle tends to be changing, you can always pause or exit it, and without worrying if what you are buying today is at value or not. Also, it's very important to review your positions regularly. So you have to either do a weekly review or a midweek review so that you are always aware how much overall open risk you have, and how much is the risk of each position, and how your positions are performing. Next step is to define your process, and risk management will be an integral part of your process. So now going forward, we will define how you can build a process for managing both value as well as growth investments.